Okay, I think that we should be able to work this out, um, hopefully. So I'll just give 2 more minutes and then I'll start. Okay, I think we should start now. I'm going to just share my screen. Great. As usual, let me know if you're able to hear me and see me on your chat box. One of you, please. We had started the capital gains schedule by talking through that schedule by asking about that a problem sheet that was given to you, which was about E12 Industries. And I'm just going to read that out for you so that we are able to understand what's going on. E12 Industries Limited is the food processing industry, and it's in the food processing industry and supplies processed food to airlines. The E12 factory suffered some damage in a major fire accident, and the machinery belonging to E12 was damaged to the extent that it was no longer useful as a machinery and had only scrap value. Since the machinery was insured, E12 received a sum of money from the insurance company. The revenue wants to impose a tax under the capital gains provisions on the difference between the amount of money received under the insurance contract and the original cost of the machinery in E12's hands. Decide this case assuming that the current tax provisions do not contain any reference to money received under the insurance contracts. And I gave this problem to you in order to try and see how we understand this problem in the context of um, capital gains provisions, right? And we begin, as usual, by looking at the basic structure of the capital gains provision, which begins with Section 45. Section 45 says, any profits or gains arising from the transfer of a capital asset affected in the previous year shall, save as otherwise provided in some sections as 54, 54, B, D, E, EA, EB, F, O, G, and H, be chargeable to income tax under the head capital gains and shall be deemed to be the income of the previous year in which the transfer took place. And we started with this basic section and this basic problem. And we said that the Section 45 has several variables in it that we need to talk about. It talks primarily about a transfer of a capital asset. So we need to know what's a transfer, we need to know what's a capital asset. And then if there's a transfer of a capital asset, then it will be chargeable to income tax under the head capital gains. We remember that the definitions of transfer and capital assets are in Section 2. And we said Section 2 says that a capital asset is defined in Section 2, Clause 14, 1-4, and it says capital asset means property of any kind, whether or not connected with his business or profession. So it's a very wide term, and it connects the definition of a capital asset to property of any kind. And then transfer is defined separately in section 2, clause 40. Just give me a second. Section 2, clause 47, where it says transfer in relation to a capital asset includes, and the first clause I is very important. It says the sale, exchange, or relinquishment of the asset, or 2, the extinguishment of any rights therein. And this case, which is the case of Vanya Silk Mills, was important for us because it went into what the definition of a transfer is for capital gains purposes. And it said, whether receiving insurance compensation for a destroyed asset constitutes a transfer of that asset under the Income Tax Act of 1961, triggering in capital gains tax. And the facts were that the case concerned the taxability of insurance proceeds received for machinery destroyed by fire, the facts given to you. And the court here interpreted the idea of transfer, the definition of transfer. And it said that the court interpreted the inclusive definition of transfer in Section 2, clause 47 of the Act, which includes extinguishment of any rights therein, to be limited to the extinguishment of rights on account of the transfer of the asset. So it does not apply to extinguishment of rights due to the destruction of the asset. The assets should still remain, is what the court was saying. The court used the principle of nociter resources to interpret the phrase extinguishment of any rights therein, saying that it takes its meaning from the associated words like sale or exchange, etc., which are, in which sale or exchange in which the assets still remain in place, and therefore it overruled the High Court decision. The court disagreed with the High Court's view that any extinguishment of right, regardless of whether it involved a transfer, attracts Section 45. It specifically stated that the High Court has misdirected itself by focusing on the extinguishment of right rather than the transfer. So why do we give this case to you? We give this case to you because we believe that this case is important because it tries to understand conceptually what the idea of a transfer is, transfer of capital assets. And it's trying to get us to understand that. What is the idea of a transfer of a capital asset? And if you have an asset and it's destroyed or it's out of existence and you get something in return, that can't be considered as a transfer for capital gains purposes. And I'm just going to stop here 1 second, and I'm going to come back to my class. Just a minute, please. Yeah, I've stopped sharing. I have a number of people here. Just give me a second. Yes, excellent. Now, friends, there's been an unfortunate beginning to this class. It's delayed because of technical issues. I'm glad we are back, and I'm glad you and I are talking to each other. The purpose of this class is not to give you just a set of slides and then ask you to mug it up. I mean, then that just goes against the very purpose of how I'm teaching this course for you. It's important that we are all on the same page and that we are excited by the conceptual complexities in capital gains, right? I mean, if we don't get that, then there's no point of presenting these slides to you, right? So let me repeat where we are right now, right? What are we trying to do? We are saying that income tax consists of various schedules, various ways in which gains from income tax are taxed. One of which is income from salary, the other is income from property, that's rental income, then income from business, and then now we are in income from capital gains. That is what happens when you have some gains that you have because you have transferred a capital asset, right? That's where we are. That's where Section 45 comes in. And then we have tried to figure out a Supreme Court case. So the highest court in the land has actually talked about some conceptual issues about what is a transfer for capital gains purposes. And the courts put its foot down and said, you can't have a transfer of a capital asset unless the capital asset remains in existence as a result of the transfer. If the capital asset itself goes out of existence, then it's no transfer of capital asset, right? This is where we were. We've done all this in the previous session. I'm just trying to ensure that, it's been a while since we have all talked to each other. So I just want to make sure that we are all on the same page while we do this, right? And this session is going to be slightly more complicated. I'm going to ask you to do some work. So I can't ask you to do that work until we have got the basics of this right? So before I move ahead, any questions or any comments on what I have done so far? Anything? Yeah, you could either talk or you could write in the chat box, but I want you to be as into this as I am so that we do some good learning in this course. Yeah. Great. Okay, so I'm going to just review the other cases we did, and then I'm going to ask you a question and want to make you work on this. Yeah. Let's go back to my sharing. Wonderful. Okay, so then we did the next problem, which was about an amalgamation, right? And I'm just going to read out the problem again for you. The Karnataka High Court sanctioned a scheme of arrangement whereby Symbiotic Private Limited, the amalgamating company, was amalgamated with Arcadia Private Limited, the amalgamated company. And under the scheme, all the assets and liabilities of the amalgamating company were transferred to the amalgamated company in consideration of the amalgamated company issuing to the members of the amalgamating company 2 equity shares of rupees 100 each, credited as fully paid up in the amalgamated company for each equity share held in the amalgamating company. Mr. Gupta, the owner of 1 share in Symbiotic, received 2 shares of Arcadia. After 1 year, Mr. Gupta sold his shares in Arcadia to Mr. Singh for a certain sum. What are the tax consequences on Mr. Gupta receiving Arcadia shares in the amalgamation? With regard to the Arcadia shares sold by Mr. Gupta, what is the cost of the Arcadia shares in Mr. Gupta's hands? First question I asked the class last time was, why are we bothered about mergers and acquisitions, which is what this is about? And the answer was, well, mergers and acquisitions is a big area of corporate activity, quite complicated, not just commercially, but also in terms of tax. The most important question that is asked when we discuss mergers and acquisitions, when 2 companies are merged, is should there be a tax on these kind of transactions? And I said that because the government thinks that if you own property through a corporation and you continue to own that property in some indirect way after mergers, you should get a tax break. So that's why it gives you these tax breaks in the Income Tax Act. And we first begin by understanding what is an amalgamation. So we go again back to our mother lode, which is section 2, where we discuss what is amalgamation. And I asked you people to take a look at that. Last time we had some discussions about the complications there. Amalgamation, which is defined in section 2, clause 1b. Section 2, clause 1, capital B. Amalgamation in relation to companies means the merger of 1 or more companies with another company, or the merger of 2 or more companies to form 1 company, in such a manner that A, all the property of the amalgamating company or companies immediately before the amalgamation becomes a property of the amalgamated company by virtue of the amalgamation. All the liabilities of the amalgamating company or companies immediately before the amalgamation become the liabilities of the amalgamated company by virtue of the amalgamation. Shareholders holding not less than 3/4 in value of the shares in the amalgamating company become shareholders of the amalgamated company by virtue of the amalgamation. And if these 3 conditions are fulfilled, then you have an amalgamation. If you have an amalgamation, last time we took you back to section 47, and we said section 47 is a section that has various exemptions. Section 47 says, Section 47 of the ITA says nothing contained in Section 45, nothing contained in Section 45 shall apply to the following transfers. And then it says in that, if you go down, it says in clause 7, any clause 7 of section 47, any transfer by a shareholder in a scheme of amalgamation of a capital asset being a share or shares held by him in the amalgamated company, if the transfer is made in consideration of the allotment to him of any share or shares in the amalgamated company, and the amalgamated company is an Indian company, right? So therefore, when we say what are the tax consequences on Mr. Gupta receiving Arcadia shares in the amalgamation, the answer would be nothing, because Mr. Gupta received it in allotment. He fulfilled all the definitions of section. First of all, this was an amalgamation because the definition of amalgamation is fulfilled under section 2, clause 1, capital B. And secondly, under section 47, clause 7, Mr. Gupta has received the shares in consideration of the allotment to him of the shares in the amalgamated company. Then the next question was with regard to the Arcadia shares sold by. No, sorry, before I go to the next question, one problem here, of course, is that even here, Mr. Gupta's shares in Symbiotic are going out of existence, right? And he's receiving some Arcadia shares, and you might say Vanya Silk Mills. If the property is itself going out of existence, then how can there be a transfer for capital gains purposes? So why do we even need to go to section 47? There's just no transfer for capital gain purposes. And in Commission of Income Tax versus Grace Collis, the Supreme Court disagreed with that. And with the approach taken in Vanya Silk Mills case, it said concerns the assessment of capital gains on shareholders following a company amalgamation, whether a share exchange in an amalgamation constitutes a transfer under the Income Tax Act. The central issue revolved around the interpretation of transfer in section 45, and the court ultimately reversed the High Court's decision, finding that transfer had occurred and that the capital gains tax should be calculated accordingly, and the court disagreed with the approach taken by Vanya Silk Mills case. It said extinguishment, it's fine. You don't have to. There's no such thing that the property had to remain in existence. However, that issue we noticed was revisited in Nilamalai Agro Industries. But before we go to Nilamalai Agro Industries, I just want to come back to my second point, which is with regard to the Arcadia shares sold by Mr. Gupta, what is the cost of the Arcadia shares in Mr. Gupta's hands? And the answer to that is found in section 49. And section 49 talks about cost with reference to certain modes of acquisition, where the capital asset becomes the property of the assessee on various things. And the thing that we should be concerned about is where it becomes a property of the assessee because of the fact that in an amalgamation, he or she received a certain amount of money, a certain amount of shares. Then in that case, there's a special rule, and that special rule applies. I'm just going to ask you to look at section 49, clause 2, where it says, where the capital asset being a share or shares in an amalgamated company, which is an Indian company, becomes a property of the assessee in consideration of a transfer referred to in clause 7 of section 47, the cost of acquisition of the asset shall be deemed to be the cost of acquisition to him of the share or shares in the amalgamating company, right? And therefore, in Mr. Gupta's hands, with regard to the Arcadia shares that are sold by Mr. Gupta, the cost of the Arcadia shares in Mr. Gupta's hands would be what it cost him to buy the Symbiotic shares. And that is because of, by virtue of section 49 clause 2. Okay, so that's where we were, and I'm again going to come back to you, because the one thing that I don't want to do is I don't want to keep talking and people are not able to either enjoy what's happening or even sign off on what's happening, right? So I have a question for the class. Why are we in this case? And remember, we have done this previously, so I'm only trying to jog your memory. Okay, why is it the case that the assessee in this case, in the case that I'm talking about, which is the Grace Collis case, why was the assessee so bent on saying that there was no transfer? You know, when he was allotted Arcadia shares in return for Symbiotic shares, why was he so in the amalgamation? Why was he so bent, so insistent that there was no transfer for purpose section 45? When in any case, section 47, clause 7 gives him an exemption, right? Exempts that kind of transaction from capital gains. Yes, please. Who's going to answer this question? We had done something. We had talked about this in the last session. I'm only trying to ensure that all of us, just it's been a while, so I want to ensure that you're absolutely on top of this. And it's an interesting conceptual legal issue. Yes, somebody has raised their hand. Is that Usha? Yes, Asha.
Yeah, Asha.
Yes, sorry, Asha. Yes.
Since it's a case of amalgamation, probably there is no transfer of shares. There is what is can be understood, because ownership is moving in the amalgamation.
Yeah, but why do we say that there's no transfer? See, what's happening in amalgamation? In the example I've given you, what's happening in amalgamation is that I own some shares in a company called Symbiotic. That company merges into another company called Arcadia. And then once it merges into Arcadia, Symbiotic goes out of existence. But the shareholders of Symbiotic get some shares in Arcadia. So far, you're with me, Asha?
Yes, sir.
Yeah. Now, there's been the question, the revenue may come and tell you, the income tax people may come and say that to the shareholders of Symbiotic, that you got your Symbiotic shares were worth 1 rupee. In return, you got Arcadia shares worth 10 rupees. Let's assume, speculate. So you got something valuable. And there was a transfer of Symbiotic shares in the sense that Symbiotic shares went out of existence and you got some money in return for it, right? So there's been a transfer of a capital. Symbiotic shares a capital asset. So there's been a transfer of a capital asset. And in return for 1 rupee of Symbiotic share, you got 10 rupees of Arcadia, right? So you got something valuable. There's been some capital gain. Would you disagree or agree with that, Asha?
It's a matter of time also. No, suppose the Symbiotic shares have been purchased quite some time back, and
yes.
then Arcadia, so the prevalent market showed that shares.
Yes, that's right. The value of Arcadia shares might have gone up. The point is that the Arcadia shares you received, you're a Symbiotic shareholder. The Arcadia shares you received are very valuable, and they're more valuable than the Symbiotic shares you gave up in the amalgamation. Don't you think that this would be a transfer of a capital asset?
Yes, there is a benefit, sir, in that. There is a gain in that, but to consider that a capital asset, I'm at a loss to understand.
That's right. What the revenue is saying is that there has been a transfer of a capital asset. What the assessee is saying, taxpayer, is saying that there's no transfer at all because, and this is where I think we should all pay some attention, right? Because this is where, you see, there are two ways of looking at all these kind of things, right? Which is that we do this application of rules mechanically, but that's very tedious. And that's not what tax law is. That's not the exciting part of tax law. The exciting part of tax law is how rules and principles can be manipulated almost as by magic to be in somebody's favor, right? And this is what the taxpayer here is trying to do. What the taxpayer is trying to do here is to say, look, we just discussed, the taxpayer saying, we just discussed the Vanya Silk Mills case, where normally any capital asset, anything that happens to it is, it's not always transfer. But Vanya Silk Mills case has made it very clear that if in the course of transfer, the capital asset itself goes out of existence, there is no transfer for capital gains purposes. So, of course, that case was about something destroyed in a fire. But the taxpayer is saying it's the same thing here. This share of mine, symbiotic shares, goes out of existence in an amalgamation. It's out. The company is gone. I've got Arcadia shares in return, and therefore there should be no transfer for capital gains purposes. Now, my question, Asha, you're with me so far, right?
Yes, sir. So actually, my point of dispute there is, in case of in the first case that you said, there's a machinery is lost due to whatever reasons.
Destroyed.
Destroyed. So there's nothing that he can get from it. He just got a compensation for a small amount, but that cannot be considered as a capital gain.
No, the compensation wasn't small. The compensation. So say you had bought the machinery for 100 rupees, many years ago, and you got a compensation for the whole amount under the insurance contract. At the time you got the compensation, it could be that you actually made a gain because your cost in the asset may be lower than what the insurance compensation was. The Vanya Silk Mills case says even then there should be no capital gains tax here because the asset itself has been destroyed. Now, in this case, in our the second amalgamation case, the taxpayer is making the same argument. If I am in an amalgamation and the share that I give up is itself going out of existence, then there should be no transfer. Even if what I've received is valuable, Arcadia shares are valuable, even then there should not be any tax for capital gains tax for income tax purposes.
So
yes.
Sorry, please.
No, I just want to complete. Yeah, sorry. I'll just complete this and then I'll call on you. And then the revenue saying, no, there is a transfer. I had an initial question for you. The question was slightly different from what you might have been anticipating. My question was, in any case, whether it is a transfer or not a transfer, in any case, Section 47, Clause 6, anyway, exempts these kind of transfers, right? If you go to Section 47 says in Clause 7, sorry, not Clause 6, Clause 7, it says that if you receive a share in amalgamation in return for the share that you gave up, there's no capital gains tax. If that is so, my question to the class was, why is the taxpayer even insisting that there was no transfer for capital gains purpose? It's a very interesting legal nuance here, right? Somebody has written something. Hold on, let me see if somebody has got that. Okay, so that has said, in your example, if there is no transfer, then the amalgamation provision governing cost will also not apply. That's absolutely correct. Therefore, instead of the cost of the Arcadia share being 1 rupee in your example, it should be 10 rupees. If Section 45 can't apply, then the provisions governing cost can't apply. It is considered a purchase of the shares for 10 rupees, resulting in a cost bump, saving taxes on the future. Say, no, that you started correctly, but I'll tell you where you've gone a bit awry. Right? That is absolutely 100% right. If there is no transfer, Section 47 Clause 7 anyway won't apply because Section 47 Clause 7 assumes that there is a transfer. If Section 47, and please listen to this carefully, as I said, if there's any value at all to a legal course on taxation, the value lies in this kind of discussion. Now, if Section 47 doesn't apply, then Section 49 Clause 2, which I just now read out, will also not apply. Section 49 Clause 2 talks about how to determine the costs of shares acquired in an amalgamation, which are then finally sold off sometime later. If Section 49 Clause 2 doesn't apply, because Section 49 too depends on Section 47. It references Section 47, right? Section 49 Clause 2 says where the capital asset is acquired by virtue of transaction that is referred to in Clause 7 of Section 47, then the cost will be whatever you initially bought it for. If that doesn't apply, then there is no way of figuring out what is the cost of the Arcadia shares in Mr. Gupta's hands. You can't say like how Dutt is saying. Dutt is a man of logic and sense. He says, this is the cost or that is the cost. Unfortunately, tax law doesn't work that way. There is no way to figure out the cost because there can be multiple ways of asking what the cost is. Maybe the cost is 0, maybe the cost is 10, maybe the cost is 1. In cases where you cannot figure out the cost of an asset in your hands, the entire capital gains tax fails because computation provisions are as important to income tax as the charging provisions. There's a famous case called Srinivas Shetty case. It's in your course materials. Please read it on your own. In the Srinivas Shetty case, the court said, in cases where you cannot figure out the cost of an asset in your hands, you cannot figure out capital gains. Because for figuring out capital gains, if you go to Section 48, capital gains requires 2 variables: the cost of the asset and the sale value of the asset, consideration. Consideration minus cost is capital gains. If one of those variables cannot be calculated, because there's no clear rule on it, the various ways in which you can be calculated, there's no clear rule on it, then the whole calculation fails itself. This is the reason why the taxpayer, in this case, in the amalgamation case I'm talking about, was insisting that there is no transfer at all. He wanted to say that even though there's an exemption available in Section 47, he was insisting there's no transfer so that he could get himself out of Section 47, Clause 7, exemption section, which by getting himself out of that section, he gets out of Section 49, Clause 2. If he gets out of Section 49, Clause 2, there's no way to find out the cost. There's no clear guideline in the Income Tax Act on what the cost of that, underlying the cost of the Arcadia shares in Mr. Gupta's hands, and because of that, the entire transaction would fail. So this is where we are in the case, and then this case went to court. The court and I'm going to share my screen with you so that I can take you back to that decision. And in that decision, it's Commissioner of Income Tax versus Grace Collis. They said, no, this is actually a transfer because, and the court said that's because the definition of transfer is very clear. They said Vanya Silk Mills was wrong. This is the definition of transfer is quite clear. The definition doesn't only say sale or disposal, it also clearly says in Clause 2 extinguishment. And extinguishment is a separate event. And here they said, and therefore this kind of share transfers where the share itself goes out of existence in amalgamation would be within the definition of transfer. And if it's within the definition of transfer, then we don't have anything to worry. There's an exemption section, but there's also Section 49, Clause 2, which will determine what the cost of the asset in the hands of the shareholder are. However, and by the way, so we did all this, and however, if you go to and I've said at the end, but see Nilamalai Agro Industries versus CIT, and the reason why I've said that is because in Nilamalai Agro Industries, the same kind of, after Grace Collis case, the same kind of issue about insurance proceeds came back in Nilamalai Agro Industries. So, and in Nilamalai Agro Industries, despite the decision in Grace Collis, they said for example, if you have an asset that's destroyed by fire, then you get an insurance. That kind of situation, destruction of the asset or the asset being lost at sea or whatever else can happen to the asset when it goes out of existence, that kind of situation, there still can't be any transfer for capital gains purposes. And the reason why they distinguished the Grace Collis case is because they said, in Grace Collis, even though that share went out of existence, the symbiotic shares went out of existence, the underlying assets of the company did not. the underlying assets of the company from which the share value was derived did not go out of existence, and therefore there was a transfer for capital gains purposes. Whereas in Nilamalai Agro Industries, which is the same facts or similar facts as Vanya Silk Mills, that is, there's an asset, it's insured, the asset is destroyed, and you get insurance money. In that case, there are no assets underlying or not. They all go out of existence. In that case, there cannot be a transfer for purposes of the capital gains provisions. This is where we are, and it's interesting how we go about it. Let's to kind of sharpen this discussion that we are having. There are two things for people non-lawyers who are not used to the law. There are two things that I want to say something before I proceed to the next problem. The next problem is also concerned with something like this, but before I do that, I just want to say two things which are fascinating for lawyers, but I just want to make sure that people who are not used to the law are also on the same page, which is this. Sometimes the intricacies of the law is what enables taxpayers to make certain arguments, right? So the taxpayer is making an argument about whether it's a transfer or not a transfer, not because he's interested in that particular capital gains event, because he knows that even if there's a transfer, Section 47, Clause 7 will apply and it will be exempted in an amalgamation. What he is worried about is for a future event, when he receives the shares for example, in our case, Symbiotic is given up, Arcadia is received. When he receives those Arcadia shares and then later on sells it, can he escape capital gains tax? In order to do that, he is making the argument that never mind that there's an exemption section. In any case, what's happening that is not a transfer for capital gains purposes because my share itself is going out of existence. And then you notice that that's one legal intricacy that might be interesting for people. The second one is that look how courts distinguish their own cases, right? So in the Vanya Silk Mills case, they said that even though the definition of transfer explicitly includes extinguishment of rights in an asset, even then, if the asset is destroyed as a result of fire, etc., and then you get insurance proceeds, if the asset goes out of existence, there's no transfer. Then you come to Grace Collins, which says no, it reverts back to this position that transfer, the way transfer is defined in Section 2, anyway talks about extinguishment of rights, and therefore even if the share goes out of existence, it should be the case as a transfer. Then you come to a case like Nilamalai Agro, which is a case of insurance, same facts as Vanya Silk Mill case, where the court is now saying, no, we still believe, and Nilamalai Agro is, by the way, a high court decision, but it is distinguished in the Supreme Court. It is saying, no, we still believe that if there's a total destruction of an asset, there cannot be any transfer for capital gains purposes. The Grace Collins case is different because in Grace Collins, even though the share went out of existence in the amalgamation, the share derived its underlying value from the assets in the company that went over to the amalgamation, and those assets were still in place. They didn't go out of existence. So that's where we were. Now we come to problem 3, and the reason why I'm asking you to solve problem 3 is it's connected to what's happening, but what I've said so far, but it also talks about some other interesting issues. Friends, take a look at problem 3. It's on your screen, and I'll give you 5 minutes. Tell me, in solving this problem 3, I want you to take a look at section 54F, section 54F, clause 1. So 54 has a number of clauses. I want you to take a look at section 54F, clause 1, and then section 54F, clause 3. There are lots of intricacies there. Only look at the basics. Only look at the main points in section 54, clause 1. and section 54 clause 3, and then we come back to me in 5 minutes time. I'll only give you 5 minutes. Just do a basic analysis of your own, and then I'm going to ask you what your answer might be in this question. Yeah, 5 minutes. Right? I'll come back in 5 minutes. Make sure that you have attempted this problem in those 5 minutes. Yeah, 5 minutes. I'll come back. Don't Google, don't do all those things. Just look at the sections and answer the problem. Yes, who's ready to talk? Let me just simplify the whole thing for you. So I have a house. I own it for a few years. I have a building. Sorry, I own it for a few years. I sell the building. I invest it into a residential house. What happens to me? Raise your hands, please, or you can do it in the chat box. Anyone, please? Mm-hmm. Yes, please. Let me repeat this for you. I have a building. It's not a residential house. Let's assume that, and I just sell it. I just sell it, and I make some money, and then I invest that in a residential house. What would be the? Somebody had raised their hand. I'm not able to see.
Yes, sir. Can I speak, sir? I'm
So,
Asha here.
yes, Sasha, please go ahead.
So when the person is owning the building, that is a capital asset. And when they
That's
sell it, they get a capital gain out of selling that building.
that's right.
And investing in a residential house, there is something in capital gains that if you invest in a residential property immediately within a span of time, which I'm not very sure about, then you can avoid a capital gains tax, is what I'm
That's
not
right.
very sure. Yeah.
That's right. No, that's fine. That's fine. So the answer is that yes, under Section 54F, 54F Clause 1, if you invest it in a if you invest your proceeds in a residential house, then there is an exemption from capital gains tax to that extent. We don't have to go into the mechanics of what that exemption is, but you should just have an overall idea that there's an exemption. Now, Section 54F says that the transfer has to be a transfer of any long-term capital asset. Now, long-term capital asset has been defined in Section 2. All of you, by the way, when I'm doing this, there are two things all of you have to have in your respective places. You need to have the Income Tax Act with you. You can either buy the Bear Act on your own, or it's freely available on the web, but you need to have it with you when I'm talking so that we are all able to understand the tax provisions carefully. And you need to have my course materials, the ones I've given to you on the VLE. You have to have that with you because we refer to case law quite often, right? So if you go to section, the section 54F comes into operation only when you transfer a long-term capital asset, only then. And that has to be a building and not a residential house. What's a long-term capital asset? What's a short-term capital asset? A long-term capital asset is defined in section 2, clause 20. Section 2, clause 29 AA, 29 AA. A long-term capital asset means a capital asset which is not a short-term capital asset. Sometimes legal definitions can be quite amusing. All they've done so far is to refer you to another definition. So a long-term capital asset means a capital asset which is not a short-term capital asset. And a short-term capital asset is defined in section 2, clause 42A. Section 2, clause 42A. A short-term capital asset means a capital asset held by an SSC for not more than 24 months, 2 years, immediately preceding the date of its transfer. So this has been held for 2.5 years, so it's not a short-term capital asset. It's a long-term capital asset. If it's a long-term capital asset, Section 54F allows you to then get an exemption if you invest it immediately within a certain period of time. The period of time is mentioned in Section 54. You don't have to worry about it right now in a residential house. So the idea is, the answer to the first part of my question is that he will get an exemption when he invests in section in a residential property. Of course, there are some exceptions there. For the time being, you don't have to worry about it. Now, when within a few years, I've said that within a couple of years, I've said that that person then demolishes the house, right? what is the consequences? I've asked you, what are the consequences of that demolition? Right. So that's the question that I've asked. And does anybody have an answer to that immediately? What the second part of the question was, yes, he has invested, but after investing within a certain span of time, after 2 years, Mr. Gupta demolished the residential house. If he demolishes the residence house, what might be the consequence?
The value of the house, Asha here again, the value of the house
Yes.
should be zero, but the plot of land will have value there.
No, see, the problem here is he's demolished the house already. I mean, the demolition, he hasn't sold it to anybody or transferred it to anybody. He's just demolished it. And what I was getting at here was in section 54F, clause 3, where the section says where if you're invested in a residential house where a new asset is acquired, and then that is transferred within a period of 3 years, then you lose your capital gains exemption. Then whatever you had made in the earlier capital gains transaction kicks in. Now I have a question for the class. So this is fine. Now I have a question for the class. First of all, first question for you. Why is there a capital gains exemption in this situation at all? That is, when I have a long-term capital asset, and then I sell it, and then I am exempted from any capital gains on it, because if I invested in a residential house. Why? Why is there a capital gains exemption in the first place?
Because the same amount is getting utilized towards purchase of another property, which again is a capital asset itself. And
Yes.
yes, and then
So to
you are not
encourage
making profit.
to encourage, and also to encourage people to invest in residential houses, and you're right, the same amount of money is being invested in some other properties. So for the time being, so therefore there should not be any exemption. Why is this exemption removed then in section 54 clause 3 if you again transfer it within a few years?
Amount, sir.
See, if you sell a property and then you invest in a residential house, that gain is exempted. But there's another section that says that if the new residential house that you invested in, if you transfer that again within a few years, in this case the period is 3 years, then your earlier capital gains exemption is lost. You'll have to pay tax on the building that you had sold. Why? Okay, so that is Indulekha. Oh, okay, sorry, I missed out. Indulekha had said something and Dutt has said something, and I missed out on those two. Let me just read that out. Dutt is saying that section 54 clause 3 is there because the long-term capital gains exemption is removed because it might be considered a property flip within less than 3 years and an adventure in the nature of the trade. That's broadly right, Dutt. I think the idea is that they want you to invest in a residential house that is meant as some kind of a permanent residence for you. That's what they want to encourage. It's not that they want to encourage you to invest in property. They want to encourage you to invest in a certain kind of property, the characteristic of which is more permanent, and it's your house, it's where you live, etc. If you don't do that, if you're using this to kind of keeping on flipping, as you put it, then that exemption is not given. This is an example of tax policy, of how the government has a certain policy in mind, and it doesn't want to do that. Now Indulekha has come right to the point, which is very good, Indulekha, because the second question that I'd asked was, if you demolish a house, will that be caught by section 54F clause 3, which is talking about where a new asset is transferred within a period of 3 years, you lose the exemption. And the question therefore is whether demolition is transfer for capital gains purposes. Now, what's interesting is that the word transfer, we should take the same meaning of the word transfer that we took for everything else, which is in section 2, and it does talk about extinguishment, right? And you have this this Grace Collis case, etc. But even here, in a case that is titled, um, if you go to your reading materials now, this is where I ask you to go to your reading materials, and if you go to your reading materials, you will see that in note 20. Note 28, please make a note. In note 28 of your reading materials, there is a case called Chaya Parekh versus DCIT, 2013 case. It's a High Court decision, Chaya Parekh. And in that case, the court said disposal is not a transfer because they said Vanya Silk Mills case applies. The asset is completely destroyed. Even though Colin, so again, they distinguished, they said that the Grace Collis case only applies to amalgamations where the underlying assets still remain. But in a case like this, where the house is destroyed, it won't be considered as transfer for purposes of Section 54F and for purposes of capital gains. That's the Chaya Parekh case. And I've put 3 paragraphs in that case for you, and I'm going to read that for you right now. Chaya Parekh case, the court says the revenue does not dispute the entitlement of the respondent under Section 54F of the Act on the purchase of the bungalow property. However, the grievance of the revenue is that as the respondent had demolished the bungalow within 3 years of its purchase, the same would amount to transfer and would be hit by Section 54F, Clause 3 of the Act. The tribunal dismissed the appeal of the revenue by placing reliance upon the decision of the Apex Court in Vanya Silk Mills case. In the above case, the Apex Court had held that when an asset is destroyed, there's no question of transfer taking place under the Act. The Apex Court held that in terms of the Act, that the words extinguishment of any right in Section 2, Clause 47 of the Act does not include an extinguishment of right on account of destruction. It has to be an extinguishment of right on account of transfer. Thus, a destruction of assets when not on account of any transfer would not be hit by Section 54F, Clause 3 of the Act. And Counsel for the Revenue seeks to distinguish the decision of the Apex Court in Vanya Silk Mills case, that the destruction in that case took place by a fire and it was involuntary. And the court said, no, that distinction has no consequence. In our view, the decision of the Apex Court in Vanya Silk Mills case would squarely apply to the facts of the present case, and therefore this would not amount to transfer, and therefore Section 54F Clause 3 will not apply. They did not even talk about the Grace Collis case here, so they didn't even bother distinguishing the Grace Collis case. They just said this case will not apply. So it's something interesting for you to think about. Please, after my talk is over, you must go back and read the cases I mentioned in the course materials. It will give you a sharper sense of all the issues that we are talking about. Now, I'm just going to stop here. Any questions, doubts, anything so far that anybody wants to discuss before I move on to the next? I'm still in capital gains, but I want to move on to something else, which is also quite interesting. Okay. All right. I'm just going to share my screen again. Yeah. And now we are going to talk about an interesting case called Commission of Income Tax versus Gautam Sarabhai Trust. And the issue in this case was, the facts were that the case revolved around a company amalgamation where the shareholder of the amalgamating company received both shares and bonds. Bonds are just basically securities in the amalgamated company. The court examined whether the shareholder was exempt from capital gains tax under Section 47, Clause 7 of the Income Tax Act of 1961. Sorry. The tribunal The issue was whether the facts in the circumstance of the case, the assessee was entitled to exemption under Section 47, Clause 7 of the Income Tax Act. The tribunal, however, took the view that Section 47, Clause 7 does not explicitly restrict the shareholder from receiving anything other than shares, and that receiving bonds in addition to shares does not disqualify the assessee from the exemption. And the High Court was tasked with resolving this dispute over the interpretation of Section 47, Clause 7, specifically whether the composite consideration of shares and bonds could qualify for exemption under Section 47, Clause 7. The High Court ultimately disagreed with the tribunal and held that the consideration must be solely shares and nothing else. Friends, this is where I want you to do some thinking, right? This case, I've given you the issues, the facts, what the tribunal said, what the High Court said. It will not make sense to you unless you actually read the case. As I said, the NLS courses here are designed for you to read the case and try to debate on the merits of the case with me. This is what I want you to do for the next 10 minutes. I want you to go to your reading material, and I want you to go to note number 25. Note number 25 in your reading material. Please read it and tell me on what basis did the High Court come to this decision. This is note number 25, Commission of Income Tax versus Gautam Sarabhai Trust, Gujarat High Court, 1988. I'm going to give you 10 minutes. I want to come back at 10:40. I want you to tell me on what basis did the High Court come to a decision of this sort. Yeah, 10 minutes. I'll be back in 10 minutes. Okay, I'm back. Um, yep. Any thoughts on this? Yes. Anyone, please. Yes, please. Anyone? The question I'm asking is on what basis did the court take this decision in Southern Sarabhai Trust case? Yeah. What is the basis for its decision? Yeah. Anybody? Yeah, because our problem in this case is that it's a very, in some ways, the issue in this case is very simple. Right? In an amalgamation, Section 47, Clause 7 says that shareholders, when they transfer their shares, they get something in return. That transfer is exempt. The question is, can they also get something in addition to that? Right? That's the question that we are asking. So let me read that Section 47, Clause 7 for you. It says that um, the following transfers are exempt. Any transfer by a shareholder in a scheme of amalgamation of a capital asset being a share or shares held by him in the amalgamating company. Just give me a second. I think I just have to, just give me a second, please. Yes, please. Yeah. So, yeah, Section 47, Clause 7 says any transfer by a shareholder in a scheme of amalgamation of a capital asset being a share or shares held by him in the amalgamating company if the transfer is made in consideration of the allotment to him of any share or shares in the amalgamated company. Right? So now the question was, in addition to uh, you know shares, can some other thing be transferred to the shareholders of the amalgamating company? And the court said no. And my question to you was, what was the reason for the court to say no? And one of the things that the court was trying to do is to ask ourselves, what is the normal grammatical meaning of Section 47, Clause 7? The normal grammatical meaning is that the transfer is made in consideration of the allotment to him of any shares or shares in the amalgamated company. So it says in consideration of an allotment. Normal meaning is that it's a share for share exchange and that nothing else should be done. And so they said normally, unless there are some special considerations, unless it leads to some kind of an absurd interpretation, we should stick to what the normal grammatical meaning of that section is. And the normal grammatical meaning is that it should be just a pure share for share exchange. This is critical. So if you're advising people on mergers and acquisitions, please make sure that that exemption only applies. Remember, when there is only a pure share for share exchange and not anything else. Now, my friends, as I told you, you're in NLS class, so we're not going to just mug up things like this and then forget about it. I want to ask you, why did the court say this? Or why do we have a rule that says that you can't, in a merger or acquisition, you can't have, uh, you can't transfer anything else in addition to the shares? Any reason for that? Yeah, somebody has to think. I've given you 10 minutes to think. So, any reason why this might be the case? Somebody has to answer this. I mean, otherwise, you're sitting here just listening to me. You have to exercise your brain cells a little bit. Yeah, and that's the fun of tax, right? The fun of law and tax, which is that there must be some reason why the court said that. There must be a reason why we are interpreting section uh, section 47, section 47 clause 7 in this manner. By the way, we are not taking a break in this class. I mean, I'm giving you work to do. We're not taking a break in this class because we started the class a bit late, so that's why I'm going ahead. There's no formal break here. I just wanted to work through it. We have about 15 minutes left, and I want to give you one more problem to solve. So, but before I do that, I want to ask your opinion on this. Yes, so please, someone tell me. I feel like I'm speaking into the void. Somebody has to tell me why. I mean, either chat or talk. It doesn't matter if you're wrong. That's not an issue. I just want to tell me why you think that um, Section 47, Clause 7 is interpreted in that manner, right? Okay, so Dutt is saying something. Let's see. The court may have ruled that way because it perceived M&A to occur to make business units more efficient. If it ruled the other way, then people would transfer valuable consideration tax-free. That's absolutely right. Yes, that's correct. So the idea here is that if anything else is coming out, say in this case, please remember, I thought somebody would point this out already, but was not pointed out. So in this case, remember that the two companies involved are Shahi Bagh and Al Kapuri, right? These are the two companies involved, Shahi Bagh and Al Kapuri. And Shahi Bagh is actually um, um, the parent of Al Kapuri. It owns 100% of Al Kapuri, right? That's an important fact to remember. And then the parent company is merging into the subsidiary company. That's another unusual fact, right? So the parent owns 100% of Al Kapuri. Al Kapuri has some valuable cash. If you normally take this cash out, if Al Kapuri sent a dividend to Shahi Bagh, there would be tax. Instead of doing that, what Shahi Bagh is doing is it's merging into Al Kapuri, and then Shahi Bagh's shareholders get not just Al Kapuri shares, but whatever cash is there in Al Kapuri, right? And so they're basically, as Dutt is absolutely right, this is a tax avoidance scheme. They're using the amalgamation to take cash out of, in this case, it's bonds, where it could be cash. Bonds are basically just like cash. They're taking something out of this company without paying tax on it. They're saying it's a tax-free reorganization. And the court wanted to prevent that. So the court was, and I think the court was right, and that's why it was interpreting in this fashion. And of course, there would be other problems as well, other consequent problems which were pointed out in the judgment. The other problem would be that how do you determine what is the cost of the Al Kapuri shares now in the hands of the shareholders of Shahi Bagh? Because 47 clause 2, 49 clause 2, which applies to determine the cost, never envisaged that there would be also some money going out, right? And so if you notice if you just scroll down the decision, you will notice the revenue has made this argument in para 10. Revenue has given you an example, right? In a scheme, this is the revenues example. In para 10, I'm just reading it out for you. In a scheme of amalgamation, the shares of an amalgamating company whose cost is rupees 10,000 in the hands of the shareholders of the amalgamating company and the market value of rupees 100,000 are transferred in consideration of the shares of value rupees 1,000 and the cash of rupees 99,000 of the amalgamated company. The shareholder of the amalgamating company will pay no tax on the cash receipt of rupees 99,000 and will claim at the time of the sale of the shares of rupees 1,000 of the amalgamated company that their cost of acquisition will be taken as rupees 10,000. And therefore, there's a capital loss under 49 clause 2. And this would be an anomalous situation, right? An odd situation. And so that's what the revenue was trying to say. And to me, it looks like the court was doing two things. It was saying, look, you can't take out cash tax free in amalgamation, and second, it will lead to these kind of odd situations when you do that. Great. So that's the decision. Any thoughts, my friends, on so far on what's been happening, and is there anything else that you wanted to share, or you have doubts? Or remember, this today's session, because we have talked about these things in quite some detail. These are tough cases to understand, so you'll have to go back and read it, and you'll have to do some homework. You listen to me and you've taken a quick look at the cases, but you have to do a little bit of homework when you go back, and you'll have to take some time and make sure that you understand this better. And I'm always there for you, both in doing this class and also my associates. Shinjini will be there for office hours. So please do. Yes, please. Somebody has raised their hand. Please go ahead.
Sir,
Yes,
where do we find this Gotham case, sir? It's not available in the notes, no?
Oh, it should be available. It's in note number 25.
Okay.
If somebody else can help you, note 27, Indulokya is saying. Yeah.
Okay.
Note 27. Yeah. You know what you should do? You should do a search or something in case my notes don't correspond to yours. Just do a search of the case itself, and you'll get it.
No problem. Thank you.
Great.
Thank you, Indulekha.
Great. Okay, now I'm going to head back to, I'm going to give you one more problem, and let's see what you people think about it. And this problem is here. Yeah. Yes, how do you solve this problem? This is a problem that we have given in the past to some of our students, and I just thought, the discussions this has got nothing to do with amalgamations or anything of that sort. But this is a problem in this area generally, and I thought it might be interesting for us to all sit down and see how we solve this issue and whether you have any thoughts on it. I'm just going to read out the problem for you, and we'll discuss it together. A had been allocated debentures by XYZ Limited on April 1, 2015 at a face value of 100,000 debentures, redeemable on April 1, 2023 for a sum of 200,000. On redemption, the debenture certificate is cancelled and A is paid a sum of 200,000. It is specifically stated in the debenture documents that the final redemption amount is calculated by taking into account a compound interest rate that will amount to 100,000 in 8 years' time. The debentures are not traded in the stock exchange. The revenue is claiming that the redemption of NCDs, this is non-convertible debentures, they're not convertible into shares. The revenue is claiming that the redemption of NCDs, these debentures, would not give rise to capital gains as claimed by A, and further, the difference between the maturity proceeds upon redemption of the debentures and the cost is to be assessed as interest income of A under the head income from other sources. Decide. Any thoughts, my friends, on this? I have a few. Let me, while I'm doing this, I should mention a few more things about what's happening here. First of all, we have been talking about the capital gains schedule. And in the capital gains schedule, we have talked about issues like transfer of a capital asset. What you must remember, although we will not say this in any more detail, what you must remember is capital gains, even when they are taxed at a special rate. Those rates are usually lower than the usual slab rates that the taxpayer are subject to. Anybody knows what the capital gains rate is in India? This might be common knowledge. Anyone? Capital gains tax rate. Sorry, I'm not able to see you, so you'll have to speak out. Okay. Sorry, what did you say?
15%.
No, actually, no, it's not 15%. They've simplified the tax rates, and other than some special circumstances, the tax rate for long-term capital gains, long term, which is an asset held generally for more than 2 years, is 12.5%. And for short-term capital gains that are assets held for less than 2 years, the usual rule, general rule, is that it will be subject to the slab rate, usual slab rate that the tax. Suppose the taxpayer is earning a lot of money, he'll be subject to 30% tax slab rate. So that will be subject to 30% tax. But for long-term capital asset that is held for more than 2 years, it'll be 2 years or more. It'll be 12.5%. Why is there a special capital gains rate at all? Anybody? Any thoughts? Yeah, in this case, I'm taking silence as an uncertainty among my audience. I'm uncertain as well. The usual reason given for special rate for capital gains is that to encourage investment, right? To make people buy assets and sell assets and things like that. But I never understood why we must, in addition to the profits people are already making, why the government must provide a special rate for investment in capital assets. I've never understood the tax reason for it, but this is a reason given usually, and it's there worldwide. India is not the only country. Every country has a special rate for capital gains. So in this class, we also understood the difference between short-term capital gain and long-term capital gain. I went over the definitions with you, and I've also told you about the rates, and I'm now telling you about some complications in some situations regarding transfer. But this is an interesting. This is actually based on an actual case, and I wonder what might be the answer. Can somebody speculate what's the answer? What might be? What could be the? This went to court, and what did the court say? Can somebody speculate on that? Let's see. I'm actually going to just close because we are in the last 2 minutes. I'm just going to close this and come back to my. Let's see. Okay. So that has been saying something. It's been saying correct. So that you've been saying exactly what I've been saying. So good for capital assets. But here you're saying that the court has likely stated as interest income, which is absolutely correct. And yes, it does look like an original issue discount, although don't worry, that's a jargon word. But yes, the court in this case interestingly said that even though you're receiving interest, even though you're receiving an amount only at the end of 8 years, the nature of that amount is still interesting because it's been calculated on that basis, right? And it's not capital gains. And you notice here an interesting, subtle legal issue, which is here, this case is not just about capital gains or interest income. It's actually about how to fit a certain set of transactions or facts into a certain schedule, right? So, and it makes a difference. Suppose it was interest income and not capital gains. What will be the result? Anybody? What might be the result? Tax. What is the tax advantage of this being capital gains? Because that's what the taxpayers might argue. Taxpayer will argue it's a capital gains, or he may even argue it's a capital receipt, but there's not even capital gains, because where is the transfer of a capital asset? The debenture is destroyed completely. It's gone. It goes out of existence at the end of 8 years. So where's the transfer of a capital asset? He may say that, but let us say that there is a transfer and that there is actually a capital gain of 100,000. Why would the taxpayer argue that? And that is right, because as I just now said, capital gains are subject to a much lower tax rate, especially if it's a long-term capital asset. And so the taxpayer may well argue that this is a long-term capital asset, and and therefore it's subject to 12.5 grains. And Dutt is on a roll today. He's hitting all the right answers. That's correct. Also, it might well be that the taxpayer has some capital losses somewhere, and he could net this capital against those capital losses. We haven't come to that part yet in our course, Dutt, so you're a bit ahead. There's a separate session on capital losses, which I'll be doing. But yes, there's that. By the way, there's another advantage which Dutt has not mentioned, which is that he can use this debenture proceeds, invest it under Section 54F, for example, or some other Section 54, to say that it's exempted because it's capital gain, but since I've invested again in some other asset, it's existed. I don't know whether Section 54F will apply, but there could be some other section in 54 that might apply. So he could do that. He could reinvest the proceeds, and but Section 54F itself may apply because it says any long-term capital asset not being a residential house. So there's that possibility. He can reinvest the proceeds somewhere else and apply. All those possibilities are not available to him if what he's got is going to be interest income. Who is H? Who has said interest income under the head income from other source? As in, what's your name, sir? Or lady? I don't know. I can't figure out who H is. Because that's the right answer. Vivek. Hi, Vivek. Yes, interest income under the head income from other sources is what it will be classified as. And if it's classified as interest income, he'll be subject to the slab rate of 30%. So that is the issue that the court in this case said it's interest income. So it's an interesting case, I think, from a point of view of how to classify income and what are the tax advantages and disadvantages of classifying the income under various heads. All right, great. It's been a great session. Some really interesting answers. Asha has not been here before, so I'm very happy that Asha came and discussed. I don't remember talking to her in the previous sessions, so it's great that she was here as well. Yes.
I was participating, but in a very small way, no doubt.
Oh, you mean in the earlier sessions?
Yes.
Oh, okay. Sorry then. Sorry, I forgot. Okay, great. So it's lovely to have interactions because that's how we were able to make sure that the thing doesn't become tedious. And I'm thankful to everyone. And let's looking forward to our next session, which will be income from other sources. And after that, international tax and tax avoidance. Okay, thank you very much. Have a nice weekend, all of you.
Thank you.